Over the years, there have been a lot of attempts at the perfect formula for beating the stock market. But yet most investors and traders still underperform the S&P 500. Since 1998, data scientists at Earnings Whispers have studied approximately 350,000 earnings releases to find out what makes stocks go higher or lower after the announcement. As it turns out, it isn't that hard. It doesn't take a rocket scientist. All you need is one simple tool, a ruler. By plotting a company's annual earnings along with the stock price over the past several years, and then adding on the next 2 years of earning estimates, gives a reasonable projection of where the stock is going. You can run a ruler across the plots, or look for the history symbol at Earnings Whispers. Then click Annual. Taking Apple as an example, we see the stock has followed fairly closely to the company's earnings over the longer term. This marks where shares of Apple are currently trading and the earnings and revenue estimates for the current fiscal year. This marks the current estimates for the next fiscal year and, assuming the stock follows the same path, where the stock is likely to go next. We've calculated this line at the time of every earnings release since 2003 and found stocks trading below the trend line outperform the overall stock market by 75%. Meanwhile, buying a stock after its earnings release, when it trades above the same line, underperforms the rest of the market by 84%. So the next time you buy or sell a stock following an earnings release, put the ruler to work. Or simply look for the earnings history icon at Earnings Whispers.